Hey, good morning, everybody. Thanks for being here. I know we're getting started a couple minutes late. As you can see, the Champion staff is getting breakfast out to all of you, and really want to take just a few minutes to go over some housekeeping items. My name's Josh White. I work at Metonic as the Vice President of Investor Relations. I know many of you in here, and I just want to take a moment to thank all of you for spending a couple of hours with us this morning. I know all of you are very, very busy, and we really appreciate it. This is our second annual Multifamily Forum, and we're excited to spend the next couple of hours with you. On your table in front of you, actually, when you checked in, you got a packet of information, and there's some really good pieces of information in there, and some of our speakers will be talking through some of that today, so appreciate you having that handy as we go through everything. So just a couple of things before we get started. You know, I get to work with some amazing people each and every day, and they are here, and so I'm going to introduce them just by department. We're not going to go through all of their names, but Metonic has grown immensely over the past few years. We're up to 28 people between the Metonic and Apogee teams, and most everybody is here today. So by department, if you are part of any of these, please either wave or stand up and hold your applause to the end. But we've got our finance and acquisitions department. So raise your hand or stand up. There we go. Asset management. I know we've got many of those folks in here today. Yeah. The legal team. Adam, I think we're missing part of the other legal team. And then we've got some others that are part of our legal staff. And we've got Apogee. Where's Apogee? There we go. Back there. Cassie. Yep. And then investor relations, there's Jenna back there, me, Adam. So really appreciate what everybody on these teams do each and every day. And then I also want to thank Jenna. Wave to the crowd. There she is. Many of you have seen Jenna's name or have gotten to know her. She is the one primarily responsible for putting this together. And none of this would be possible without her. We really appreciate what she does. One quick note, we've got a lot of investors in this room, and we really appreciate you trusting us as we make investments in our properties on your behalf. And we are, as many of you have seen, we have undergone some interesting challenges with our software. We're taking care of those. We're getting a really nice investor-facing software. And that'll roll out in Q4 or Q1 of next year, and we're really excited about that. I know Trey's in here. He's been intimately involved in that. And then Molly Laws, you'll see her name. She's part of our finance team as well as our investor relations. So thank you for being patient regarding our software. So moving on, in your packet you have an agenda, but I can quickly go over that as breakfast is being served. We're going to have 3 sessions this morning. We wanted to make it informative as well as being timely, so we'll have you out of here by 10:45. We will be hanging around after, so if you have any questions or want to speak to us individually about anything, please come up and find us, tap us on the shoulder. But hopefully everything will go smoothly, and we'll have you out of here by 10:45 or 11 o'clock. The sessions we're going to be talking about is we're going to first go through housing trends, basically what is happening in the market, specifically relating to multifamily. We will also then have Amanda Brewer from Habitat for Humanity and Katie Kemmerling from the Two Hawks, moderated by Caleb Beller, talking through some innovative partnerships that we've embarked upon. And then we're going to hear from Bob and Cassie about how our current developments are doing, as well as our next phase of developments, and inform you about all of those. So some things that we're very, very excited about. You know, when we originally set out to do this, when Adam and I and Bob and a couple of others were talking about what this would look like, we really had just a couple of goals in mind, and we've stayed true to that. One is to provide an expert summary of the current state of the multifamily real estate market. Another one is to educate the community on the advantages of multifamily investing. I look at it as many people really don't know the ins and outs of investing in real estate. And that was one of our initial missions or goals, was to help provide some education regarding that. And then last but not least was a little bit of a showcase for us, but also to provide all of you with an in-person look at our upcoming investment opportunities. So I'm going to get started with our first session, and I'm really, really pleased to welcome a couple of people here to provide a really good outlook on what's happening in the multifamily real estate market. We have Holly Eganey and Scott Mosbach, and some of you have probably seen their names on things that we have done. But why we have them speak, we're really focused on being ahead in the market and identifying renting as a lifestyle choice for consumers. And at Metonic and Apogee, we've created models including the Apartminium as well as the Apartmiddle. The Apartmiddle is our workforce brand, specifically based upon renter identified preferences. And as we go about this post-COVID environment, we thought it would be helpful to hear from both Holly and Scott on what's happening in the market, what they envision, what they see going forward. So I'm gonna throw some questions at them, and please, if you have a question, raise your hand or wait till the end and ask anything you like. A little bit of background on Holly. She's the Executive Vice President and Chief Operating Officer of Tracy Cross and Associates, located in Chicago, Illinois. She joined the company in 1993 and has been instrumental in the company's growth. Holly's involved in mentoring and managing the firm's staff. She authors project-specific feasibility studies as well as market studies. Holly's also involved in strategic planning initiatives for the company's builder and developer clientele and is an expert in the multifamily sector. So she's well qualified to speak on everything that we're going to be talking about today. Scott Mosbach is Vice President at CBRE here in Omaha. Scott has over 12 years experience in valuation and advisory services in Omaha in the Midwest. Prior to joining CBRE, Scott was an appraiser in the Kansas City area. He primarily focuses on Iowa, Nebraska, and South Dakota. Thank you both for being here. Holly, I'm going to start with you as we go along here and talk about trends and impacts and markets and rates and absorption. And really, I have two questions for you, and you can kind of pick and choose, but I just want you to start talking. How has the work from home trend impacted rental housing? And secondly, at a local and regional level, what have you seen for occupancy and rent growth, and do you expect those to continue?
First of all, I'd like to thank you and Bob and Cassie and all the Metonic team for asking us to join you today. We've been working in the Omaha market for about 22 years, and I feel that Omaha is sort of my second home. As far as the remote work situation, I think that one of the unexpected results of the pandemic and everything that we've gone through the last couple of years is that people have become acutely aware of their homes, how they live, how they work, what works and what doesn't work. And that is in both the for sale and the rental sectors, but particularly in the rental sectors, because in many cases you not only had one person working from home, you had two. And so then there becomes the issue of when you have to have a Zoom call, how do you handle, two conversations happening at once? How much space is there on the kitchen island for both of you to work? I mean, it just became all kinds of things. What we have seen is a stronger desire for very, very functional units, whether they be studios, junior ones, or one bedrooms. Particularly if you have a 2-bedroom or larger, you can generally use that second bedroom as an office if you need to. But what we're seeing is a definitive move toward workspaces other than, as I said, the kitchen island or the bedroom. People want to be able to spread out a little bit, to be able to have their office, or for that matter, their personal items somewhere besides where they're fully exposed to any guests that might be in the unit. So we have seen a desire to have, even if it's a little nook off of a kitchen or a living space where you can set up a desk, set up some electronics, close it off if necessary. We've seen a strong desire for mutable spaces in the community centers so that you can, almost an exaggerated version of the old phone booth, where you can close the door, have a private meeting, or have one or two associates if you're meeting together, and use the community centers of our clients' properties have become more than just social spaces or more than just recreational spaces. They've become a secondary office where you can get out of your apartment, stay a little more focused on your work and what you're supposed to be doing remotely, and have the advantage of a fresh environment, but private and quiet. So we're seeing a lot more emphasis on those kinds of spaces in the community centers, and more interest in a little bit larger units that can facilitate a variety of needs. As far as absorptions, rent growth, there are several slides in your packets that we don't necessarily need to go through, but one of the things that I think is very important to note is that we did a comparison of Omaha to similarly scaled Midwest metro areas, areas like Kansas City, Lincoln, Grand Rapids, Madison, Wisconsin, areas that have similar core industries, similar core environments in technology or manufacturing, or a strong presence of universities that really mimic the character of Omaha as a region. And all of these slides will if you look at them later, will show you that, first of all, while Omaha, not to minimize what happened the last 2 years with employment, Omaha did not fare as poorly as many of its comparable metro areas, and in fact has come back stronger than most in terms of recovery. You're nearly back to where 2019 employment levels were. In terms of absorptions, similarly, Omaha has ranked among the top markets in terms of absorptions of both new construction as well as older stock. The market is very tight here. We typically look at vacancies at 5% as being a balanced market. There's enough available units for people for movement within the marketplace. In Omaha, it started trending downward very quickly in 2019, actually, before the panic set in. And right now, we're looking at roughly 3% vacancies region-wide among all product formed, all asset classifications. In the new construction, Class A, which is, of course, what we're here to talk about today, those vacancies are less than 2%. Almost across the board throughout the suburban market for sure. It is a very, very tight market. Omaha has also seen fairly strong rental increases across the board over the last 5 years. It has actually led the suburban market in rent increases, generally averaging, again, across all asset classifications, somewhere between 5 and 6% a year on an annual basis. The last 2 years, those increases have jumped to more like an 8, 10, in some cases 12%. What I want to caution is there's a slide in there that talks about the last year. In 2021, rents were up 14% year over year. In year-to-date 2022, they're up 17%. Those rents include older established communities, which we would consider to be like B-class assets. And one of the reasons for the strong growth in there is because they were so behind in terms of how their rent growth had been occurring, that they were at such a much lower base that they really attributed to, in large part, to the overall rent increases the last 2 years. And even with those increases, they are still well below where the Class A properties are, because of course they do not have the energy efficiencies, mostly do not have the kinds of amenities that today's renter is looking for. The Class A properties, obviously the Metonic properties included among that, rent growth has averaged about 7-8% the last couple of years. We see it tapering off, pardon me, a little bit over the coming year not because of any issues with the Omaha economy, but because of the broader base of interest rates, inflation, all of those things. Incomes are not keeping up with housing affordability. So we see that the growth in rents over the next couple of years will start to trend back to a more balanced level, probably more in the 5 to 6% over the next year. And long term, we're projecting that rents should grow at a rate somewhere between 2 and 3% annually for, say, the 2024 through 2027 period. That's maybe conservative. I get a lot of pushback when I say that, but we feel that that is a fair estimate, considering there are still a lot of economic headwinds coming our way.
Thank you, Holly. Can everybody hear Holly okay? Yeah. Great. Scott, are you going to eat while you talk?
For a moment there, I thought they were looking out my waistline.
So thank you, Holly. That was a good snapshot of where we are in the market and with occupancy, rent growth, and appreciate it. We'll get back to some of the other things in a little bit. Scott, over the past 6 months, what does the activity of buying, selling, financing look like compared to the 12 months prior? And I understand that you may lean on someone in the audience as well.
There is an animal in here that I'll probably. So the vehicle the vehicle has changed. The fundamentals are still the same, but to speak more experience with this, Josh Larson, a colleague of mine at CBRE Debt and Structured Finance, is here, and I'd ask that he answer that on my wonderful behalf.
If everybody can hear me, I don't have a mic, but just over the last 6 months, everybody knows 10-year treasuries ran almost 200 basis points. So looking at interest rates, cap rates have not quite widened that much yet. So everybody's game is leverage right now. Previously it was debt funds at the beginning of the year. Debt funds have pretty well dried up, and today it's more Fannie, Freddie, or banks to achieve leverage anywhere above, say, 65%. Spreads today have widened out a little bit too in comparison to the beginning of the year. We're looking at 130 is probably the tightest spread that I'm looking at right now for a conservatively leveraged deal. Let's say 55%. I have a quote out right now, actually, right there. So you're looking at a 475 all-in rate as probably the tightest rate you can get on a 10-year fixed. That's full interest only, but full leverage all the way up to 70%. You're looking at 200 basis point spread. So you've gone from a 3.25%, 3.5% rate at the beginning of the year all the way up to north of 5% today. So cap rates still need to widen out a little bit, in my opinion. Lenders have brought in the reins a little bit, but we're still pushing for leverage. The vehicle was debt funds, life insurance company, and Fannie Freddie at the beginning of the year, and it's been hot and cold. Today, debt funds are, I don't want to say non-existent, but few and far between. And the main game in town is banks and Fannie and Freddie for long-term non-recourse debt.
Thanks for pinch hitting for Scott on that, Josh. And Scott, you work a lot in the appraisal market and doing valuations. Can you talk a little bit about how the interest rate movement has impacted valuations?
it's going to be surprising, but it's been very minimal to date. The first issue is as an appraiser, we're always looking behind what just happened, and the interest rate increases haven't quite hit what we're looking at in terms of how we're valuing. But that said, there is a 300 unit complex under contract in the metro right now it's going to be a sub 5 cap, year one going in, and the interest rate's going to be 5.25 on a 30 year. So the impact on value, it's crazy, but it's not occurring. And if an appraiser, this is my shameless plug, if an appraiser tells you otherwise, you just have to look at the market and see what's occurring, and values are they're strong, staying strong. The other thing is while it might be negative leverage in year one, the rent growth that's occurring at 5, 6, 7% turns that into positive leverage in year one. And even if it's negative in year one, year two is definitely going to be positive. So, it's just not having that much, if any, negative impact on values at this point. Not to say that it won't. I mean, you have another huge interest rate increase where you're at 6, 7%, then something will have to give, and it'll be in the form of your year one cap rate. So,
thanks, Scott. Holly, I'm going to switch back to you. Many of you have heard us talk about our Apartminium product, and for those of you that may have not seen it or heard about it, we launched our Apartminium product with the initial build of Ravello 192, which is at 192nd and Pacific. Apartminiums, it's a kind of a cool play on words, but really you get the amenities of apartment living with the luxury of a condominium. And those have just gone over so well in the greater Omaha area, and we've continued to expand upon that. And Holly did a white paper for us on the Apartminium, and I'd love for you to share some of your thoughts from that study today.
I'd be happy to. First of all, I think the Apartminium product line is a very exciting and very innovative approach to multifamily housing. It appeals across multiple consumer groups, multi-generational households, and it has all of the advantages of an attached for sale product particularly, and has actually, I believe, will have a much stronger appeal going forward as not only to renters by choice, but renters by necessity. What has happened in Omaha, when we did the paper, we looked at the comparison of the resale market in Omaha over a 5-year period in both the single family detached and attached sectors. And then we looked very specifically at focusing on the move down or move over, I like to call them consumer. Now that I'm there, I'm a move over, not a move down. But we looked to say, well, what is here in Omaha? What's available to them? Where is it priced? And what do you get for that as opposed to a choice, a renter by choice lifestyle? And what we found was really very interesting. First of all, there is a relatively limited amount of opportunities for the lower density attached marketplace here. Part of it is because the home builder market in Omaha is primarily made up of smaller scale, relatively smaller scale regional builders. There are no publics here. Development is done typically in phases in master development communities over a long period of time. So you might get 25, 30 units delivered in a phase at a given time, but it's not a continual process. The other and the most disconcerting part of the market was that we found the median price of a single family home excluding of existing homes. We excluded new construction. Again, looking at the move-down buyer in particular. And we found that the median price was about $250,000. That's fine. The median sales price of an attached or ranch villa, single-family villa, in this market over the same period was $300,000. Now, right away, there's a bit of a disconnect. We assume most move-down buyers will have had strong equity and may indeed be paying cash to move over, but they still have to pay an HOA for maintenance. They still have to pay taxes. They still have to pay all of their utilities. There are a lot of additional expenses, as we all know. Anyone who owns a home knows that. When we compared, and on that point, although the median sales price was just at 300, active listings for similar new products in the new construction sector, the median list price was 403. So we're looking at a price point that is well beyond the affordability of many in the market who would feel comfortable in a move-over situation, and certainly beyond the point of young families or those who might be considering a for-sale option. When you look at the apartmentium with everything that is included, which means you are getting not only your exterior maintenance, you're getting your snow removal and lawn care, you're getting your water, refuse, water sewer, refuse, internet. Am I missing anything else? You have an attached garage that's included. When you have all of that, the value, we did analysis and looked at the comparisons, and the apartmentium product was about I think maybe it was $200 a month higher on a monthly payment basis, except what you have to consider is most of the for sale options do not include any form of community amenities. They might have a park, they might have green space or walking trails that are part of a master community, but there is no recreational or social amenity that is specific to them. In the apartmentium communities, in addition to not only having all of your exterior maintenance and everything paid for except your telephone and your electric bill, you also have all of your interior maintenance. So you no longer have to worry about, I have to call the plumber, I have to call the furnace guy, I have to do. All of that is also included in the apartmentium, which is a big benefit. And you have the recreational and social amenities right there on property in very much a community environment. When we looked at those, the apartmentium product, as a general rule, was about $400 a month lower in overall monthly payments than for that same resident to have chosen a for sale product had they been able to find one. So we are very strong. I mean, the apartmentium, I'm going on and I'm sorry, but the apartmentium product appeals to young families who are right now probably going to be priced out of the home market for quite a while. It appeals to professional couples, professional singles. It appeals to a single parent. It appeals to the move-over buyer, the move-over cohorts that may like the lifestyle opportunity of have literally a lock and leave situation. And with again, with the economic headwinds that I think we're all facing, I think that this is an opportunity that will grow and become stronger in this market, particularly because people are going to wait out now. Nobody's going to go and buy a new home at the top of the market and potentially see their investment go negative overnight if we have a minor repeat of what has happened before in the housing market. So I think that this is a very strong opportunity. And on top of it, your locations around the region are really well positioned in terms of accessibility, closest to in-place established shopping, healthcare, employment. I think it's just been really a very innovative entry to the market.
Thank you, Holly. Scott, as we kind of continue, we've got about 15 minutes or so, and I have a couple other questions for you, and the audience might have a couple as well. You see a lot of properties. What trends or types of properties do you think are most impactful to consumers? And then secondly, if you just want to take this one as well, why do you think so many people are building right now locally and regionally?
Yeah, those two questions they kind of go hand in hand. The apartmentium that Metonic is developing, Metonic's not the only developer developing those. You see there is Sundance out of North Dakota or Minnesota is putting up similar asset type. CIP out of Lincoln, Nebraska. They like to call theirs villas. They're very, very, very popular. Once one is completed and during construction, the lease up trajectory it's hard to forecast because it's so strong. So the consumer, the renter, specifically out west, and you will even see this in the Midtown market, they are seeking that space. It's far more functional than your traditional, bricks and sticks, 3 stories, 4 stories, everybody on top of each other. and that can also explain why it's so popular is nobody lives above you. Nobody lives below you. The only place they live is next door. And in these neighborhoods in Omaha, you can see, especially those that are zoned R4, the houses are they're right next to each other. So what's the difference between 10 feet of grass and a wall? That 10 feet of grass and the house that you buy, you have to mow, right? So the consumer, to Holly's point, home affordability has now just decreased significantly, and renting is far more appealing, and purely a home financial standpoint. So the product of these villas, the apartmentiums, it's a single family home, almost, right? So you can raise a family in them. There's plenty of green space to throw the football. So play catch, do whatever you're going to do with a family. And then also the empty nesters, we're seeing that they really enjoy not having to mow the lawn, not having to paint the interior, not having to fix the fridge. All those things are covered in that rental rate. And to the second part of the question, why are so many people building right now, both specifically locally? We do a lot of fundamental demand analyses in the housing market, and there's 1 million people in the Omaha MSA. I don't know why you don't get to see that more often, but there's 1 million people in the 7 counties that make up the Omaha Metro. That includes the counties in Iowa. The annual population growth rate is over 1%. But if you just use simple math, 1 million times 1%, that's a lot of people moving into the metro every year. And to Holly's point, the only national builder in the market is D.R. Horton, and they just got here. They're way behind the curve. The supply is so short on places to live, and the demand is so great. Our math, and this it might blow your mind, our math on one of the more recent fundamental demand analyses that we did was there's a 50,000 unit shortage of residences, and that's both owner-occupied and rent, for rent. So the most apartments that have ever been delivered in a year, just apartments, is around 4,000. You're not making up that gap. The economy, specifically in Omaha, both basic industry and beyond, is so strong that people are going to continue to move here. It's going to continue to grow. And once the census shows that we are over 1 million people, the larger national retailers that you don't see here, but you see in Minneapolis and Kansas City, are going to be fighting to get here. We're already seeing it happen on some of the retailers. I always like to throw out Neiman Marcus and Nordstrom, because I think everybody here would love a Nordstrom. They will start to look here because of that population growth. So to answer the question, they're building because they have to. There is, I believe at one point on the MLS, for an MSA with a population of this, there needs to be around 15,000 homes, for sale homes available. At one point last year, there were 800. So there's nowhere to live, so you got to build. So, I mean, that's the crux of it, is lots of people, lots of demand, very little supply. And it benefits the investor tremendously.
Thanks, Scott. I don't know about all you. That's the first time I heard a couple of those numbers, and I think Scott may want to consult for the chamber to get some major retailers here. The last question is for both of you. If interest rates continue to climb, we talk about this quite a bit, but what impact does that have on home buyers versus renters?
Well, the obvious answer is you've just, for the short term, removed the first-time buyer from the marketplace. I mean, there's a statistic that was out on Friday that showed that nationally, the median price of a home is 5 times the median income of a household. And that is just a differential that cannot be, it's unsustainable is correct, thank you. We believe very strongly that the rental market here in Omaha will remain very tight and very strong for the foreseeable future. Certainly beyond we usually forecast in 5-year increments. So beyond the 2027 end of our immediate forecast period, but we feel it's going to remain very strong for that very reason, because you have young people who are delaying moving into a for sale option simply because they can't even come up with the down payment. At a 20% down payment, if you have a $350,000 purchase price on a home, you have to have a $70,000 down payment to begin with. And, you know, yesterday, mortgage interest rates hit 6.5% again. When you add that to our current inflation rate problem and you start to put those numbers together, you can see that it is not a good, it's not a good option at the moment for certainly the younger components, which are the primary renter, you know, the under 35s, but also, you know, the 35 to 45s are going to be holding off. And I think that speaks well to the strength of this market long term. As to alluding what Scott said earlier, there is also post-pandemic a shift away from your traditional corridor living. You know, if you're very young and you're just out of school and you've got your first job, yes, you're going to want to live, you know, downtown where, you know, where everything's accessible for about 1.5 years until you can't stand your roommate anymore and you need your own place, or you've decided to get serious about your profession. So then you're going to start to look for a realistic environment to live, and it isn't necessarily going to be the higher density product. It's going to be something that feels more like home. We expect that turnover, which is typically 30 to 35% in a normal market. People move, you know, 30 to 35% of your renters will move every year for a variety of reasons. We think that, especially in Omaha, turnover is probably going to drop down to something like the 25% mark, and among older tenants, it may hit below 20, because if they have a product that feels and lives like a home, like the apartmentium, there's not the urgency to live because they've got all of those conveniences and they have some space. And so, and they don't have people running up and down the corridors and all of the other things that you kind of think of in traditional apartment development. So we think the market's very strong.
Scott, anything to add on that?
Yeah, to Holly's point too, the younger renter wanting the Blackstone, the district, the downtown. I like to try to think that I'm young and go to bars out west, right? And I'm surprised by the number of young people that are in West Omaha, if we're speaking specifically about Omaha. So the trend in, I know I'm not talking about interest rates, but the trend in renter, I mean, it's all age groups, all cohorts across all people, and they're living in all three of those markets. And there's large, I mean, I'm obviously following Dodge here because all economics in this town run on Dodge and I-80. The age, the type of renter, you will see the same person downtown that you will see in Midtown that you will see in the western suburbs, which is fairly unique to any major metro in the Midwest. So yeah, it's to Holly's point, to what we're all speaking to here, is it's keep building them.
Well, and also, if I could just add one last thing, over the last 5 years, the suburban market outside of the downtown, midtown sections of Omaha, the suburban market accounted for 75% of all absorption in this region. And there are always little fluctuations in that, but that's been historically true, and I don't think that it's going to change.
Yeah, and I know we're probably going too long, but the rental rate, I'm always looking at things on a rental rate per square foot per month. So I was talking to Bob Dean about this earlier this morning. 5 years ago, hitting $1.25 a square foot was the goal, right? The West Omaha new Class A stuff is over $2 a square foot. And while that is like, holy cow, when you have somebody moving here from Chicago that's paying $6 a square foot, they see $2 a square foot and they get 1,200 square feet, 3 bedrooms, 2 baths, hard surface countertops, new carpet, all that stuff. They're all over it. So yeah, the rent growth has just been tremendous, and it's really neat to see because, like I said, 5 years ago, which doesn't seem that long ago, $1.25 was the benchmark of success, and now, I was telling Bob, I just heard the deal that's going out at Valley Shores. This is Valley, Nebraska, is they're hitting $2 a square foot on those units. And that has to do with the population growth occurring in Fremont, which nobody really recognizes Fremont. But it's not a bedroom community to Omaha. It's one imaginary line away from being a part of the metro here in Omaha. And so, and you add them and you add Fremont, and you're over 1 million people in an instant. So that's really, it's strong. The market's strong.
We have a couple minutes. Any questions from the audience? I know someone's got to have something. We can run a mic out too if you don't want to yell.
What are the risk factors? What are the watch-outs? We heard a lot of good things. What are the watch-outs? There's always risks.
For multifamily?
Yeah.
So if you look at vacancy is the risk, because if you don't have somebody renting, you're not making money. Construction costs are also a risk. However, the increases in rent have almost mitigated the increases in costs, meaning when you have a new project like Alora, there's significant risk there. The construction costs are over $200,000 a unit. I think they're closer to $300,000 a unit. How is that going to appraise out? Well, the rental rate's achievable, more than value that out. So that risk is mitigated. The construction cost risk is mitigated purely by the rental rates that are achievable in the market. The rental rates, I don't want to say they won't ever decrease, because you will see them decrease. I guess the largest risk is, will population increases in this metro subside? And something major would have to happen for that to occur. And by major, I mean the Great Recession, which, I mean, we've all lived here long enough or have studied this market long enough. The opposite occurred here during the Great Recession. More people moved here because of the financially safe environment. You can buy a home here versus Laguna Beach, right? I was talking with someone else here. I lived in Southern California for 5 years, and I'm 40, and I've owned a home since I was 20, ever since I moved back to the Midwest. And my friends that live in Southern California are just now buying their first home, and they're in their 40s. So I guess the biggest risk, and to answer your question, is if the population growth subsides, there won't be much need for more units, and you'll reach a economic occupancy level of 95%, and you'll stay that way. But markets never stay that. They're never in what's the word I'm looking for? They're never static. They're either up, they're down. They're never just gonna, take the easy way. So the biggest risk to me is if that population growth subsides, you're just not going to need housing. But our studies, it's not subsiding at all. It's the opposite is occurring.
I heard one other question over here. Someone was talking.
Yeah, so you guys mentioned a couple things that are unsustainable. One of which is obviously you can't be paying cap rates that are below your interest rate. What has to give in that situation? I mean, Holly, you mentioned 2 to 3% growth rate. If you use that and kind of flex off some of the numbers, Scott, that you were throwing out, it's going to take you 4 years to make up that delta, not 1. And so is it, hey, valuations need to change. If interest rates continue to go up, that's going to cause an even bigger problem, or are growth rates just being under forecasted?
Let me just clarify, and then I'm going to turn that over to Scott. When I said 2 to 3%, I'm talking about starting in 2024 and going through as a conservative measure against potential, if rent growth continued at a trajectory of 5, 6, 7% a year, incomes are not following. And then you're going to have a situation where it could start impacting occupancies. So our feeling is, or properties will have to start offering incentives to encourage lease up to stay at stabilization. What our recommendations are, and it's strictly recommendations, is in today's world, at this point in time, you can project another 5.5% increase, and then start to slow it down to 2.5%, 3%, again, in today's world, so that you are not in a position where you have to start to worry about incentives or any kind of discounting or reduced rents. What will happen is there's, in addition to in-migration from other areas, there is also, as I said at one point earlier, about 30% of renters move every year for a variety of reasons. 50% of them will stay local, stay renters, and look for a new place to live. So your pool in terms of new development opening up is not only new household formation, but also to capture a percentage of those mover renters. And as long as your rents stay within a reasonable appreciation rate, you will not find yourself in a position of having to discount. If a project starts continuing with the 5, 6, 8% a year rental rates, they are going to have problems because they will be quickly passing the affordability levels of most of the renters. So now,
in terms of cap rates, I'm speaking specifically of year one going in cap rate. You will see a basis point increase going pretty soon. It's gonna happen. I don't know when it's gonna happen. I don't know if it's gonna be tomorrow. I don't know if it's gonna be the next interest rate increase, but it's gonna happen. You're gonna see a 25 basis point increase, a 50 basis point increase, and how that affects value is every increase in our going in cap rate that reduces the value of the asset. But on some of these assets, we have to be doing a discounted cash flow analyses where we go in with whatever we know of today's going in cap rate year one, increasing the going out cap rate by a conservative 50 basis points, and then using 100 to 200 basis points on your discount rate. And then we're increasing over that hold. We are only increasing our trends 2%, because that's the average inflation over 100 years. And you could do the average inflation over the past 10 years. It's always right around 2%. Even with what's occurring right now with inflation, in 10 years, it's going to be 2%. It might be 2.1%, 1.75%. So to answer your question on cap rates, at some point in the future, with the trajectory of interest rates, you will have to see fundamentally an increase in that year one going in cap rate. On the contrary, you may not see the point for point increase on your going out cap rate. There's always that 50 basis points is the benchmark on your going out. Well, if you have a let's say it's for easy, if you have a 5% cap rate and you forecast 2% growth, you're going to want a 50 basis points. But if values are increasing over that time period at a greater rate than the 2%, your going out cap rate may very well be 5% again. So there's a lot of factors that go into it, but the year one cap rates, purely because of interest rates, you have to see an increase in the year one going in cap rate at some point in the very near future.
Well, I appreciate, let's give a round of applause to Holly and Scott. We're going to take a short 10-minute break. We're going to pick it up right at 9:15, talking about innovative partnerships. Thanks again.